It is July 26th, 2024, and I'm going to show you my trade on CCJ Camco. Broke below the 200-day moving average right here. Not a good sign, okay, but I am buying right here at 44.50, 44.75. I'm buying 1/3 of a position, and I'm going to take you through my logic from both technical and then later on a fundamental point of view, so you can understand the risks if you want to buy into this stock now too for yourself, but you do have to do your own due diligence. Look, my main concern here is that right now this thing could be morphing into stage 4 Sam Weinstein breakdown. So I'm going to try and get like a stop somewhere below this low. If this is really the range where we're at, then I'll be okay. If this thing goes in here and then kind of pulls back and then maybe, you know, resumes, to use Weinstein's terminology, a stage 2, that is really my bet by getting in right here. But this does report on July 31st in about 5 days. So there is this gap down here in between support. I mean, you could always get this reporting and then it gaps down. So I am eliminating this risk of this huge little price gap from 44 down to 42. With position sizing, I'm going with 1/3 my normal position. And if this maybe then comes down into here, gap down, right, and then kind of bounce on earnings, so I'll have room to add right in here, maybe another 1/3 of a position. And then hopefully maybe if this thing kind of comes down and then goes back in, I'll get to add in another last 1/3 somewhere in here to get the full position. And then, you know, I'll still be around this 45 price area. But let's clear all of this up here. This is a risk, okay? This could definitely happen. This is not set in stone that this stock is going to go ramshackling higher with the price of uranium. I'll show you why that this is a real risk, so you're going to have to really set a stop in here. My level, somewhere around here, haven't determined it yet though. And the reason you would see some kind of a real breakdown is fundamental, right? So the future's not yet determined, but let me show you the fundamentals that I've gone through. First, I did an ROE decomp on here on this this return on equity and the EBIT margin. This is what I'm concerned about here. This has never really produced anything in the way of operating margin over the course of, you know, what, this many years, back since 2016. ROE is the same. It's never really earned any kind of return on the equity that's been put into the business. So what we have with all that is, going over to the valuation tab, we have an expensive stock. Here I've put in my estimate for what net income could be, and this is double their previous net income. And the reason they would get that is if you take roughly their annual production times the $70 price of uranium, which may or may not happen with their contracts. I'll go over another article to see what we can get an estimate of their price per pound. That would give you this revenue based on 70, and if you get a real low EBIT margin, right, 7%, that would give you this much EBIT, and then you take about 75% of that, which could be their net income after taxes and everything, to get this number, right? So that all comes from this price at this production per pound would give you this net income, and that is a stretch. As you'll see, let's go to their previous net income right here was 360 million. So if you want to get to a 750 million net income, that's really pushing it, right? So that's long term, but let's see if it's even reasonable to assume that. Okay, so if they did get there, look, you're talking about a 26 PE right now based on the current market cap, with a huge aggressive assumption of what net income could be. So this is the risk. I mean, that's 26 PE is really expensive. So this stock, even if it does what it's supposed to do, right, to get this and doubles its income, it's still expensive. So it could either, you know, tread water right at 40 or really get killed in stock price if it just, yeah, doesn't get anywhere near, if it doesn't double, right, its income. So you're talking a lot of risk here. But now for the reward side, right, the risk is there that this turns into a stage 4 right now. But if you go over to the reward, let's say that they get 27% EBIT margin, which I don't think is unreasonable, okay? Then you're talking a 7 PE and you could get a $100 stock. Now keep in mind, this is EBIT margin, right? So 27%, is it reasonable to assume this 27%? Well, let's see. Right here, we've got the net profit margin, right? So that's not even EBIT, which is operating. This is net. And back here in 2006, you had 27%, 26%, right? Low year with the great economic financial debacle. Then right back up, okay? So I think tops net profit margin could maybe get back up to these again, which is 25%, let's call it, okay? So if you've got 25% net margin, I don't think it's unreasonable to assume maybe their EBIT could be 27 in a best case scenario, and then multiply that by what they would keep after taxes, call it 75%, right? That's how you could get this kind of net income of almost $3 billion. Best case scenario if uranium stays here for a couple of years and their margins go out. So mining companies are not going to get more than 25% because 2007 was the best ever. PE is 7 would be what it's right now trading at with this market cap, its current market cap, right? So $100 best case scenario. If you want to do ultra best, right? So I would sell at 100 if it ever gets there in a best case scenario in the next couple of years. EBIT margin at 35, which would get you somewhere around that net margin of 25-ish, right? 130 tops, so call it 125 is the richest that this stock could ever be. So one more thing I want to go over as to why I don't think that there's a lot of downside and why I'm willing to risk buying here on this chart, even though, you know, we had this breakdown below the 200-day moving average. A lot of it has to do with this article that I found from Sprott here. This is in their Insights tab if you want to go look this up. And what this guy is saying is pretty compelling. He is the technical advisor to the Sprott Uranium Trust, and this was an interview with him. I guess you can watch it on YouTube. I haven't. I just read this transcript. I've highlighted the key areas that helped me understand what was going on, but there's only a few here in red that I would care to point out to you. Basically, the price at 60 in 2024, and keep in mind that this article was done in 2023, November. This analyst, he goes on to explain why the price came up from 60 and what got it there. So I'm convinced, based on what I've read here, that the market at 60 was too low. I'm also convinced, based on what I've read here, if he's correct, that the market is in balance at $70 uranium. Okay, keep that in mind, $70 uranium. Right now, here's the price is at 74, current spot price. So at $70, we're in balance, something he's saying. And then also what's going on now is he's making an argument that the balance of power between producers and the consumers, which are the utilities, is shifting towards the producers. Okay, so the producers now are getting a balance of power, whereas all throughout this time, when uranium was all the way down here, they had no power, the producers, and all the power rested with the consumers, which are the utilities. So they could buy down here and force price down and have all kinds of power when it came to contract negotiations, which is a lot of how uranium is bought and sold, which you can read about in here. So this goes on a long way to explain all this. Says here, all right, for the first time since 2012 during the Fukushima, that power is now shifting towards the producers. So there's probably a floor around 60 and price is in balance at 70. The main thing that I found really interesting is that this is how price discovery takes place over time, right? In this market, because there's not a futures market, you don't really know the price of uranium until these contract negotiations, the terms of them come out in the earnings report. And again, CCJ reports on the 31st, it's the 26th now. So we're gonna get more information in a couple days here, and that's why I'm willing to take a little bit of a position out, because I do want it. But this is a slow process of figuring out the price. So long term, things move in a trend, kind of like the tide, but in the short term, a lot of gyrations can happen. So I'm wondering if perhaps this, sudden down move is just one of these gyrations, and that nothing fundamentally has actually changed all throughout this move here, where the stock is kind of trading below and above this $50 mark, right? I mean, this is too high and this is too low. So if nothing changes long term, I think that we're still good with this stock, and it would pay to buy on these dips down here. So a healthy market means stable prices for the miners, and that's what we do want, which would kind of justify this high multiple if they start growing their retained earnings and then can pay more of that out in maybe a dividend, or just increase their operations to become more stable. Okay? So long-term demand should support the stable market. And lots of buyers, which are the utilities and now the financial companies, are coming in here. So lots of buyers and few producers means that it should remain a seller's market for as long as the financial guys like Sprott and these hedge funds come in to start buying at the spot price of uranium. So in markets, you always want, for higher prices, a lot of demand and a controlled supply. And maybe not even a lot of demand, but a lot meaning like the more buyers there are and the fewer sellers there are, a good market. Kind of the opposite is true when you had China buying all the commodities in the world, and there was only like iron ore, and there was only like one producer, which was Australia. Not a good time to be a producer for the Australian companies, because China, as your sole or biggest buyer, the marginal buyer, can demand what price concessions they want. This is the opposite of that. And again, we'll go to confirm all of this. Here's the CCJ annual report from 2016, okay? I found this one interesting. Here's a little excerpt. Like other commodities, uranium industry is cyclical, and the low level of contracting prices at those prices down there at $20 and $30 a pound, right? It's not new. When prices are low, there's no urgency to contract. The heavy contracting that took place during the previous price run, which drove investment higher, and higher cost sources of production, contributes to the perception that uranium is abundant, okay? And now, we know that that's not true. Look, abundant and always will be, right? History demonstrates that the opposite tends to occur when prices rise, all right? So we're in that environment now where prices are rising, and then there's the recognition that uranium is not that abundant, especially since a lot of it comes from Kazakhstan, which is more or less, under the sphere of influence of Russia, more or less, not entirely, but somewhat is. So putting all that together, I think that the case can be made that right here at 45 could be a nice little support level, assuming, all right, earnings come out and you don't get one of these. This could happen, but I'm not betting on that. My bet is that maybe you get one of these at the worst, right? And then we'd still be in kind of this level here, which is still your basic stage 3, okay? And then you can still get a move up out of there, then a little pull back down, and ultimately, right, continuation of this stage 2. That's my bet. If you do agree with it, you do have to do your own analysis on this, because again, this thing could get really wild to the downside. All right, thanks for watching.
Bye-bye.